Welcome to the deep dive. Today, we're jumping into Sunoco LP's Q2 2025 earnings call. That happened back on August 6th.
Right. And if you just looked at the headlines, you might think, well, kind of mixed results here.
Exactly. But our mission really is to unpack all that complexity, cut through some of the noise, and figure out the story the market might be, well, missing.
Because often what looks mixed on the surface, it hides a pretty compelling strategic shift underneath.
Yeah, it does.
When you really look past those immediate numbers, Sunoco's Q2 financials, they show a more nuanced picture. There's real operational strength in key areas.
Contrasting with some of those headline figures that fell short of what analysts expected.
It's a classic case, really. You've got to dissect the data to get the real narrative.
Okay, so let's start with those headlines then. Sunoco reported GAAP EPS, that's generally accepted accounting principles earnings per share.
Basic profit per share, yeah.
At a pretty low $0.33. That was a big miss compared to the Zacks consensus, which was $1.68.
Huge drop from the $3.85 they posted a year ago, too.
And revenue also came in a bit light, $5.39 billion. The consensus was looking for $5.62 billion.
So that's down about 12.7% year over year from $6.17 billion.
Right. So purely on the surface, those numbers, they definitely suggest a tough quarter.
But, and this is where it gets interesting, that apparent weakness in the GAAP EPS, it's kind of at odds with this really remarkable 16% jump in adjusted EBITDA.
Okay, EBITDA being a key measure of operational profit before, interest, taxes, depreciation, amortization.
Exactly. And that hit a record for Q2, $464 million. Even if you include the one-time transaction costs, adjusted EBITDA was still super strong at $454 million.
Wow, up almost 42% year over year then.
Yeah. And their distributable cash flow that's crucial for MLPs like Sunoco shows cash available for unit holders. That was up too, modestly, but up 1.7% to $300 million.
Okay, that's a really significant divergence. So for listeners seeing that big GAAP EPS miss, how do we square those two things? I mean, is management's explanation solid?
Or could there be underlying concerns masked by just looking at adjusted figures?
Because the market, its initial reaction seemed focused on the misses, right? Shares were down about 2% pre-market, closed down over 1% that day, around $52.88.
Yeah, it felt like investors just reacted to the GAAP EPS and revenue, maybe didn't dig into the operational gains.
So how solid is that explanation?
It's a critical question. Usually the divergence comes down to things like non-cash items, one-time events hitting the GAAP numbers. Adjusted EBITDA tries to zero in on the day-to-day operational health.
Right.
Management pointed to those one-time costs, yes, and also non-cash impacts from asset revaluations linked to their strategic shifts.
Okay.
So the market's reaction, while you can understand it if you just read headlines, probably shows a missed opportunity to see where the company is actually making its core earnings.
Which brings us right to the operations, where the strategic pivot really shows up.
Yes, fascinating contrast.
And digging into the segments, it really highlights where that strength is building. Look at pipeline systems. Adjusted EBITDA there is $177 million.
That's a huge jump from $111 million in Q2 last year.
Huge. Throughput was 1.2 million barrels a day. They mentioned longer haul tariffs, strong blending margins, agricultural demand. Carl Fales, the COO, sounded pretty confident.
What do you think is driving that big jump, specifically in pipelines?
Well, it seems like better use of their existing assets combined with market conditions just driving demand for their services, right? Yeah. Longer haul tariffs mean more value from each barrel moved.
Makes sense. And you saw strength in terminals, too. Adjusted EBITDA hit $71 million there.
Up from $43 million last year.
Yeah, throughput was 692,000 barrels a day, helped by strong growth and better performance in their transmix business.
Transmix, right. That's processing mixed or off-spec fuels back into usable stuff.
Exactly. So these midstream segments, the pipelines and terminals, they provide steadier, fee-based income. They're clearly becoming the engine for Sunoco's earnings quality.
But then you have fuel distribution. That's what a lot of people think of when they hear Sunoco, the gas stations.
The traditional side.
Adjusted EBITDA, there was $206 million. Volumes were 2.22 billion gallons. That was up 5% from Q1, but actually flat compared to last year.
Okay.
And the fuel margin, the cents per gallon, or CPG, that was 10.5 cents, which is down from 11.5 cents in Q1 and 11.8 cents a year ago.
Mm-hmm. So while midstream's growing, that CPG number looks a bit soft.
What's the story there?
Well, management was pretty clear on this. They said the reduction was partly portfolio changes, like selling off some West Texas assets,
Okay.
and also, importantly, reclassifying that trans-mix processing margin out of fuel distribution and into the terminal segment results.
Ah, so an accounting shift, basically.
Right. Structural changes affecting how they report. Plus, normal quarter-to-quarter swings and the market volumes being kind of flat overall. They argue it's not core weakness, just the evolving structure.
I get the explanation about portfolio stuff and reclassification, but, fuel distribution was always their bread and butter. Is there maybe a risk this just makes the segment look better without addressing, say, competitive pressures?
A fair question.
And despite that softer CPG, management sounded pretty confident. They expect more investments, more roll-up M&A, buying up smaller competitors in the first half of 25 to boost volume and EBITDA later in the year.
Aiming for another record year for that segment, actually. Austin Harkness, the CCO, even talked about a bullish margin environment.
Which is a lot of jargon for, we think we can make more money per gallon, right? Even if total gallons don't soar.
It really speaks to leveraging their scale in what they call a hyper-fragmented industry. That's what the roll-up M&A is about.
Makes sense.
Higher break-even costs for smaller players, more price volatility since COVID. It creates opportunities for big, efficient operators like Sunoco.
Okay. And this operational growth, especially in midstream, that underpins their capital allocation, their returns to shareholders.
Exactly. And on that front, they're sticking to the plan. Consistent distribution growth. They declared a Q2 distribution, 2.908 dates per unit.
That's up 1.25% from Q1.
Right. It's the third quarterly increase in a row. Keeps them on track for their target of at least 5% annual distribution growth for 2025. Payable August 19th.
And CapEx. They spent $120 million on growth, $40 million on maintenance in Q2. Still on track for the full year targets?
Yep, seems so. At least $400 million growth CapEx, around $150 million maintenance for the year.
And the balance sheet looks okay. Leverage.
Looked pretty robust. Leverage was just under 4.2 times net debt to adjusted EBITDA. So total debt is a bit over 4 times their operational earnings. Seems manageable, shows good discipline.
Given that discipline, but also the planned M&A, how sustainable is that 5% distribution growth target, especially while integrating big acquisitions?
It's something to watch for sure, but they have strong liquidity, only about $200 million drawn on their $1.5 billion credit facility. It's a good buffer.
Okay.
And that financial discipline supports these big strategic moves. Management reaffirmed their full year 2025 adjusted EBITDA guidance to $190 to $1.95 billion, excluding transaction costs. That signals real confidence.
And speaking of big moves, the Parkland acquisition update, that was a major point on the call. Shareholders approved it overwhelmingly.
93% in favor, yeah. Still on track for a Q4 close, just needs regulatory and lifting approvals.
And the CEO, Joe Kim, sounded, even more confident about delivering double-digit accretion.
Meaning it significantly boosts earnings per share, right? Over 10%.
And anticipating $250 million in synergies by year 3. Wow. $250 million that's a huge number. How confident should we be they can hit that? What are the levers?
That is the $250 million question. Management talked about optimizing logistics, merging back office stuff, using combined scale for better purchasing, the usual synergy levers.
Okay.
Their confidence probably comes from their track record. Remember the NuStar deal?
Right. That already boosted the pipeline and terminal segments, delivered accretion, supported distribution growth.
Exactly. It's a playbook they've run before,
Yeah.
successfully. Plus, don't forget the Tenquid acquisition, those terminal assets in Germany and Poland, expected to close early Q4.
More diversification geographically this time.
Yeah. Expands their international footprint.
So pulling it all together, what's a long-term picture look like as this transformation picks up speed?
Post-acquisitions, priorities are clear. Integrate, get those synergies, and get leverage back down to 4 times within, say, 12 to 18 months.
And the long-term vision is that rotation toward fee-based midstream and terminals, trying to get steadier, higher quality cash flows. It sounds like Sunoco is trying to, shed its skin, become a different kind of company.
That's a great way to put it. Less fuel distributor, more utility-like infrastructure play.
Yeah.
And that shift to fee-based midstream is key. Those businesses usually have long-term contracts, less volatile fees, not so reliant on commodity prices or retail fuel margins.
Yeah.
It just makes the earnings more predictable, more stable.
Tenses earnings quality.
Right. And put this in context.
Yeah.
The whole energy sector saw revenues down year over year in Q2. But within that, storage and transportation, those were up. Refining and marketing were down.
So that mixed backdrop actually kind of favors Sunoco's strategy, tilting towards those more stable midstream assets.
Exactly. They're less exposed to fuel price swings, more tied to stable volumes moving through their system.
They also mentioned something interesting. The federal EV tax credit expiring later this year. Management framed this as reinforcing the idea of strong gasoline demand for decades.
Aligning with their long-held view, yeah.
Yeah.
Providing a tailwind for their core business, even as they diversify.
Is the expiration of one tax credit really a significant tailwind for gasoline demand, or is that maybe stretching it a bit?
It's probably more subtle than that. A reinforcement of an existing belief, maybe. The point is, despite the energy transition talk, the market still sees solid demand for traditional fuels for a long time.
Okay.
Sunoco's strategy isn't betting against the transition, really. It's more about owning the essential infrastructure, whatever energy products are moving through it.
Gotcha. So looking ahead, what are the key catalysts for you? What should listeners watch?
Definitely the successful closing of that Parkland deal, and then updates on synergy realization, probably starting in Q4.
Keep an eye on those quarterly distribution increases too. See if they stick to that 5% annual growth target.
Absolutely. And obviously the Q3 earnings call, that'll give us the next checkpoint on fuel margins, volumes, see if the second half strategies are playing out like they expect.
Okay. So given everything we've talked about, the market may be focusing on headlines, not the operational strength or the big strategic shift. Here's an idea. And this is not financial advice, obviously, just a strategic observation.
Go on. The market does seem to be looking backwards a bit, not forwards, maybe undervaluing that long-term shift.
Exactly. So our deep dive suggests that the current price, floating around $51.95, maybe it might be an interesting entry point if you believe in that long-term story, despite the short-term noise. The argument is basically as those big Parkland synergies start coming through and as the market gets the story, the shift to diversified midstream, more stable cash flows there could be significant upside potential.
Like $67 or higher in the next 12, 18 months, perhaps.
Perhaps. It's a play on the market slowly catching up to the operational reality, recognizing those fundamental shifts. Maybe even selling some short-dated, out-of-the-money puts to get paid while you wait. Again, just an idea.
It definitely highlights potential for a re-rating once that bigger picture, especially the synergies, gets clearer for everyone. That initial dip on what were actually strong operations could be a tactical opening for those who see where the business is heading.
So wrapping up, today we've unpacked Sunoco's Q2 2025. Strong operations in midstream, big strategic acquisitions moving forward, commitment to distribution growth, all against that backdrop of mixed headline numbers.
And it leaves us with a question for you, the listener. Is the street really valuing Sunoco's big, deliberate transformation into this diversified midstream player? The potential for steadier cash flows, those big synergies, is that priced in?
What signals are you watching to see if that strategic re-rating is actually happening?
As always, remember, what we share here on the deep dive is just for informational and entertainment purposes. It's definitely not financial advice.
Always talk to a qualified financial professional before making any investment decisions.
We hope you continue your own research. And if you have questions or thoughts on Sunoco's earnings, we'd love to hear them.
Thanks for tuning into the deep dive. We really appreciate your support and look forward to our next deep dive into the world of earnings calls.